Good morning, everybody. Little Star Wars theme on Star Wars Day. It's May the 4th. May the 4th be with you. Great to be with all of you today. My name is Bob Lang, and I run explosiveoptions.net. It's time for our daily bites on this Thursday morning. So let's talk about what's happening in the markets, what's happened the last couple of days, and what we're going to be looking forward to today and tomorrow. So yesterday, of course, the Federal Reserve concluded their two-day meeting and decided to raise interest rates for a 10th time since the first rate hike came in on March 17th of 2022. So 10 times the Fed has raised interest rates. We're up to 5 to 5.25 now. But what's interesting is in the press conference, Chair Powell said quite a few things. One thing in particular, that they do not have rate cuts in their forecast. And as the markets were rising up with the hope that that wasn't going to be heard, they turned down sharply, dropped almost 1% from those highs all the way down to the close, near the lows of the session on Wednesday when that came out. And but in the statement, they did say that they don't see, they removed the language that said additional firming of interest rates is likely. They took that out, and they said that they're basically going to be watching the data, as we all are, and they've been doing that for a long time as well too. So it is more likely that that was the last rate hike, but they've left the door open for another rate hike to come if the data doesn't come in quite as positive as they're looking for. Now, of course, this morning, we had some data come out, and we'll have some more tomorrow. We'll talk about that in just a moment. So what came out this morning? Take a look at this. So we have exports came out a little bit higher, imports down a little bit, jobless claims slightly in line. Jobless claims rose sharply versus what the expected was, but it's the non-farm productivity and the unit labor cost that have caught my eye. Now, what often happens is when you get poor productivity, as we had in the first quarter, it means that the GDP grew inflationary. It was an inflationary growth. So the GDP came in roughly 1.1%. It was basically driven by inflation, not by productivity. Productivity can get you out of a lot of bad situations. It's a good thing to have strong productivity. But when productivity is weak, you often see stronger unit labor costs, and that was the case here. Unit labor costs up 6.3% for the quarter on an annualized basis. So that's a really hot number that the Fed has got to be taking a look at. Now, Chairman Powell said yesterday that he didn't believe that the labor market or the unit labor costs, such as numbers like this, or wages, are responsible for all the inflation. Of course, that's true, because we saw goods inflation coming in, we saw services inflation coming in as well too. So it wasn't, and not everything has been driven by wages or unit labor costs. But this is certainly something that that's going to raise their eyebrows and say, maybe inflation is not coming down as fast as we had hoped for. And maybe we'll keep the door open for more rate hikes coming out. As far as the Fed funds futures market is concerned, you can see here, interestingly enough, for the June meeting, which comes in about a month, June 14th, to actually a 5% chance that they're going to take back that rate hike that they put in yesterday. Interesting, right? Go to July 26th, and you can see it's about a 50% chance that they're going to do the same thing, that they're going to pull back on that rate hike. Now, what would cause them to pull back on the rate hike? Maybe this banking crisis, which Chair Powell said yesterday is likely over. Banking crisis in the regional banks likely over. If that permeates and starts spreading to the rest of the banking names out there, they could possibly step in and ease interest rates. I think they feel like they overshot on the interest rates. If the market is looking for such a quick turnaround in interest rate, repealing this one from yesterday, that would really be a stunning move. But you'd have to have a disaster coming in. Let's look at what's happening in July. We'll have three more. June, July. We'll have two more interest rate inflation readings and CPI and PPI. We'll have a couple of jobs reports coming out in June, well, obviously tomorrow, and then June and July. Quite a bit of data coming out that could sway the Fed to either pause or possibly even, maybe even if they're going to cut rates, the market is telling them that case. Now let's go all the way out to December. We're at 5% now. December is saying that we're going to probably be somewhere between 4.25% to 4.5%. So that would be 3 rate cuts that the market is pricing in between now and December. Okay, there's only 5 more meetings left in the year, so they're anticipating perhaps a 1/4 point rate hike here and maybe there, and then December as well too. So we have to see how it plays out here. I think the market is not listening to what the Fed has been saying. And it's been the case for a while now, and actually the market had been not anticipating a rate hike up until a couple of weeks ago for yesterday. So let's take a look at the S&P 500 here for a moment. Let's take a look at this one here first, because we have an interesting bearish pattern that created itself yesterday, and actually the last couple of days, and confirmed it yesterday. This is what's called an evening star. What is an evening star? That is a 3-day candlestick pattern. I like to look for a confirmation day. So basically what it is, it's a white candle, and then you get a doji, and then a red candle. That's the 3-day pattern of the evening star. I like to see a follow-through day, and yesterday we got that follow-through day. Now, what's an important support level over here? I would say it's right here, roughly 40, let's call it 40.55 to 40.60 on the chart here. We do have some gaps that need to get filled right here and right here as well too, all the way down. And then you've got some other levels of support with moving averages, which are climbing upwards. The 100-day here, the 50-day moving average, and then of course the 200-day moving average, is down at 39.69, still moving upwards. We had a big shot in volatility yesterday, and the VIX is up again today. It's up to 19.2%. Still, it's not all that elevated here, and we're seeing a little bit of a sell-off this morning, but not too much as we would have expected. Now let's take a look at another couple of charts here. So this is one that we talk about a lot. Stocks above their 50-day moving average, right? When it's in the box, which means when it's under 50%, we say we say no bueno, right? Cinco de Mayo coming up tomorrow. When it's in the box, it's no good, right? And we try to make an effort to get out of the box in April. We couldn't get there. We've made lower highs. In fact, you can see that right in this indicator since late last year. So this could be a problem here. If we stay in this box over here, it means that more stocks are in a bear market than there are in a bull market. In fact, you look at 61% of the stocks, Fibonacci number, 61% of the stocks in the S&P 500 are in bear markets. They're below their 50-day moving average. Then we take a look at the S&P 500 as it compares to the Russell 2000, the IWM here. Now the IWM is in black over here, and when you have this divergence going on here, it's just a matter of time before they come back together. We do often see these two indices, the S&P and the Russell, and you can see they kind of mirror each other, right? But when there's a divergence like this, the bigger index, which is the Russell 2000 in terms of size, not in terms of dollars, often wins out. So we either going to see this thing move up or this thing move down, or some kind of combination of the two. They started diverging in March, of course. The S&P 500, the large caps started to do well, and the small caps were underperforming. And have been since the beginning part of March. So, something to keep your eye on. Again, the correlation had been really, really tight and really strong up until about the beginning of March here, where they kind of separated. Okay, so later today we'll have earnings coming out from Apple. Apple often comes out with good positive news and drives the markets a little bit, but we know sentiment is starting to get a little bit squishy here, meaning it's a little bit bearish. Was a little bit bullish last week as we closed out April on a high note, but it started to get a little bit worrisome here, especially since some of these big earnings after Apple are mostly out of the way. We do have Apple coming out tonight, where they may come out with a big buyback or some dividends or something like that. So that might support the stock going forward here. But I don't know. When you looked at Qualcomm last night, it was an atrocious number, and they talked about handset sales are going to be down. Taiwan Semi also said the same thing. Samsung also missed their numbers, and we heard from a lot of other chip companies that said the same thing. So, is Apple immune to that? No, of course they're not. But are they immune to the weakness in the economy? If the economy is getting weaker, no, they're not. So we'll have to see what they have to say. And again, we have to make sure that we can see some clarity here from the company. And of course, last thing tomorrow, non-farm payrolls coming out tomorrow, and let's take a look at what's expected here. Let's see here. Job situation here. Of course, yesterday ADP number was very strong, 265,000. So we're looking for 178 on the non-farm payroll, private payroll 153, which is less than what ADP was projecting. 4.2 on the earnings, on 3.6, tick up slightly in the unemployment rate. Now we did see JOLTS job opening decrease quite a bit earlier this week, and so that may help to increase the unemployment rate if they're in concert together. But the labor market is still very, very tight, and if the tightness continues, we're going to see average hourly earnings not go down that much, possibly even tick higher. So that's something to watch for tomorrow. I would going to remind you, we're still in a bear market here. It's still a bear market environment and conditions. And if you didn't believe me, look just the last couple of days, the activity and action the last couple of days should have told you that. Have some puts on. Keep a lot of cash. This is the bear playbook. Take your profits when you have them. Take them quickly. And don't, and again, live to fight another day. That's what this is all about. We want to live to fight another day so we can make it to the next bull market, whenever that opens up, whenever that starts. We don't know when. We're not here to predict when that next bull market is going to start. What we're here to do is to live to fight another day, make a little bit of money here in a bear market. And I get asked this question all the time. Hey, Bob, I can make money all the time in a bull market. I just want to make money in a bear market. Now, do you realize something? In a bear market, you can make money when the markets are going up and down. That's right. You can make money as the market is going up and down. It just means increased volatility, big moves up and down, and opportunities are opening up every single day if you open up your eyes and pay attention to what the market message is telling you. Okay, so that's going to be it, everyone. Have a great May 4th, and we'll pushing through my music to the end of the for Star Wars here. Enjoy the day, enjoy the weekend, and shout out to my daughter who's going to be turning 24 on Sunday. Happy birthday, Becky! Love you very much. And I'm here all weekend long. My wife Leanne is on her way to Quebec City. Have a great time and with her friends. And I'll see you guys all back on Monday morning. And enjoy the weekend and have a good, safe trading day today. Remember, pay attention to what's going on in front of you, and you won't get hurt too badly. Thanks, everyone. I'll see you guys all next